in a really unique position here, right? And there's for a few reasons. So one, um, the biggest one being a lot of their short positions that were built up on the last large downside have are being shed. And this is going to lead to a negative. Let me get the number for today. So we're looking at roughly $181 per $1 move, or 181 million. So $181 million per $1 move in deleveraging, right? So the more upside we get, the more deleveraging is going to occur on the market maker side, which is going to drive prices higher. There's two other things that have occurred as well. We have SLD, which is just wrapped up, right? And so all the institutions, well, it'll be wrapped up as of Monday morning. All the institutions now, have a big fresh stack of marginable capital to use in order to re-enter new positions. Um, and the VIX is still elevated. So with the VIX quite high, this massive deleverage, and SLD, there's nowhere really to position for large institutions besides the upside. Puts are really expensive. And the other thing that I want to talk about here is the row, right? And we don't talk about row a lot because it's generally irrelevant when, the Fed rate is 0. But right now it's pretty relevant. And we know um, we're going to see at least a 75 BPS increase, right? From the Fed going into November. And what this means is that far dated, well, just all calls are going to increase in value, and puts are going to decrease in value. So until the interest rate change is in, the motivation to buy what are already overpriced puts for institutions is very, very low. Because not only are the puts overpriced, they're about to lose value to row as well on the Fed rate increase. Um, Whereas calls are underpriced and about to increase in value. Right. And this is the kind of thing that can lead to a fairly significant melt up, because all of these institutions now out of their short positions, sitting on a lot of profit, are going to be able to leverage their money to the upside in calls that are going to increase in value with the Fed meeting, on a rising market that's being pushed up by market makers. So I think we're almost in a position in the market where there's nowhere else to go but up, because everything else is very disadvantageous. Anyway, so yeah, I wanted to talk about that. And I do think that potentially, and it seems extreme right now, but if this really gets going and we really start to see a lot of leveraging to the upside, I think we could see as high as like 41.35, at least above 4,000 in the next few weeks, not this week. But in the next few weeks, I could see us hitting these ranges until the VIX comes down and institutions can start repositioning to the downside, and after the row goes up, right? So once the puts are priced down fully, then institutions can start leveraging them back into them again. And yeah, I'll clip that for everyone.